ready for my star to start his video on our Talking Nachos video podcast. The amazing Dr. David Phelps, who has come up with a phenomenal title. We have people coming in, watching on Zoom, watching on Facebook Live. If you're here live, you're welcome to ask your own questions. And the title to this, which I love, David, is your financial advisor up to the task? The Dentist's Guide to Financial Freedom Without Wall Street. So before we dive into the nacho plate of your life, David, tell us, why'd you come up with that title?
Because we are in a very different market cycle, really a longer secular cycle that anybody who's of age under 65 is probably not going to appreciate. And I'm talking about going back to the early 80s when I was in dental school and then coming out of dental school, and inflation was running hot and heavy and interest rates were high. And I had no clue. I didn't know the difference of whether the economy was good or bad. I just got out of school, and just like most people, it's like, let me get my hands into some patients' mouths. And by the way, I'd also like to figure out how to be a better steward of my capital. And that's where I got involved in real estate. So we're in a different market cycle today. And my point is, financial advisors, I'm not here to bash them at all. Okay, they're good people. They just have a certain product or a certain platform to work off of. And it's been the kind of default mechanism for not just dentists, but really anybody in their career path or their businesses. It's like, you got to have a 401k and you've got to do this and that, and it's all in the financial markets, and just be a good saver, be prudent, and it's going to be good. The problem is we're in a very different cycle right now, and the vast majority of financial advisors have not been in the marketplace that long. I mean, I think it's like over 44% have been in the market, the financial advisory market, since like 2008. And so most haven't seen the changes we're going through, that I think is going to be very, very prudent for people to understand what they're looking at and how to maybe make some pivots or some changes in their future allocations.
Love that. I mean, I'm a big fan of Gary Vaynerchuk, Gary V, and you embrace the and world, right? It's not, it could be a traditional investment vehicles and something else. It could be, these are some core fundamental things we've done in dentistry. But look, dentistry has transformed over the years. We are not doing the same things we did in the 1970s and 80s. And if I'm hearing you right, we should be using that same mindset towards our investments. Is that an accurate way to put it?
Yeah, I really believe that it's going to be important that any person, whatever your age is, whatever your career path, wherever you are right now in the profession of dentistry, whether you're an associate looking to start a practice, buy a practice, you're moving up in position. I got into, Paul, you got into dentistry. I mean, number one, because, well, we had an affinity towards, helping people with their oral health and smiles and all that goes into that. And it's a very high satisfaction position to be in, although there's also the downsides that we don't want to talk about that tonight. There's plenty you do a good job of talking about that. What I'm saying is that we wanted to have some control of our lives, didn't we? Most people are like, well, I want to be in my own business. I want to be on the forefront. And yet the world and financial markets say, yeah, you do that, doctor. In this case, you go do that, put all your effort there, because that's what you're trained to do. And we'll take care of your money for you over here. That's been the way it's been for, as long as I've been alive. And as long as we've had a market that overall, and again, the last 40 years, we've had 40 years of declining interest rates, which I call huge tailwinds to all markets, financial markets, real estate markets, dental practice markets, except for darn insurance companies. And, you know what to do with them. So if you can put that aside, even, dental practices, well, have been selling for some big multiples of EBITDA in the last 4, 5, 6 years. That's not just because all of a sudden dentistry became great. It's because there's been this low cost of capital and money's chasing investments everywhere. It's everywhere. Well, that's changing right now. My point is, we got into dentistry because we wanted some control over what we do. Yet we abdicate because society, Wall Street, says, we'll take care of it for you. I think those days are over. I think we've got to learn be as dogmatic about operating our businesses and whatever we want to do with those as we are with our money. And that's not easy, Paul. It's not easy. We're not trained to do that. We don't typically take courses in business or finance or real estate or that sort of thing because we're so focused on the sciences and getting through college and then to DAT and then to dental school and GPRs and residency and everything else that we do, is that there's just no time. So we just.
And I would say even too, David, what I've noticed as a medium-age dentist is bandwidth is different than having time too, because after running your practices and doing all the things you need to do and investing all of that energy in that, where is the energy or bandwidth to now go and learn about these things? But you're sharing with us some really valuable tips, because not paying attention to this can be very dangerous. Tell me this, and I'm like my name, Dental Nachos, I have a lot of different toppings, go off on tangents. I noticed when you put this together, we say to a patient, move your tongue to the mesial, or we say mesial, and patient tunes out because they don't know what you're talking about. Well, I know my listeners, and by my listeners, I mean me, don't exactly know what you mean by the cost of capital. So that's something I've heard a lot, right? I've heard that DSOs aren't going to buy practices because of the cost of capital. This is going to happen. Just tell us like we're 6-year-olds. My favorite movie, Philadelphia, with Denzel Washington. Explain it to me like I'm a 6-year-old. Explain to us the cost of capital. I don't know if it's a crisis, a challenge. Tell us more about that.
Cost of capital, the other words for it would be interest rates. All right, so we can all relate to interest rates. We've got student loan debt, right? So we've got interest rate on it. The higher the interest rate, that's cost of capital. The higher the interest rate, the more that debt, that loan that we took on to get us somewhere, which is what we have to do, costs us. We want to buy a practice. Well, interest rates today are substantially higher than they were 18 months ago. So the cost to us to borrow the money to start a business, a practice, buy equipment is higher. To buy a home today, the interest rates are doubled. So you have to pay twice what you do today in mortgage payments to buy the same house that you would have paid, 18, 20 months ago. Cost of capital is interest rates. And if the higher the interest rates go, the more asset values come down. You just have to think about it. Same thing as buying a house. If I only have so much capital that I can put into buying a house, again, 18 months ago, I could have bought, a house, at this price point. But if you double interest rates and I only have the same amount of bandwidth in my budget, then and the cost of capital, interest rates has gone up double, then I can only buy a house half the value I could. So it's a big difference, and it does and will affect dental practices. It does and will and is affecting the real estate markets, and it does and will affect, I can promise you, the stock market. But there's a lag effect. People saying, "Oh yeah, David, you've been talking about this for quite a while, that the market's going to shift. There's going to be a correction." We really haven't seen it. And I'm just saying, I hate to say this, but I say be patient. I'm not saying be patient because we want it to happen. I'm just saying I'm a realist, and it will happen. It doesn't mean we have to pull it up and go home and quit. No, but you have to realize that everything's changing, dynamics are changing. And so it just changes the way we have to navigate with both our businesses, our practices, our investment strategies. We have to just understand it's a different time, and we can't just go on what's been in the past as going to be prognostication for the future.
Love that, David. Now, I always like to deliver immediate value so people pay attention, but now I want to shift gears and kind of in this part of the interview, I say, why should people be listening to you? Now, people call me up, text me and say, Paul, I need an associate. Why should I listen to you? And I say, well, I don't want to brag, but I wanted to play professional basketball. That failed. So my backup dream is I truly believe that I connect with more dentists than any other human being on earth, right? I have 70,000 people following me on social media. I have multiple associates in my practice. I get contacted by DSOs daily about finding associates to help people buy and sell practices. So I say, while I don't know all dentists on earth to the person, I do know a lot about how dentists think and how they make decisions. And what I see is a daily safety net guarantee is important. What I see is ridiculous restrictive covenants will not have people take your job. So when I went to Freedom Founders a few years ago, I was blown away by a few things. One, the quality of the people that you connect with. I've met the nicest people that have joined Freedom Founders. One who I helped sell her practice and get her to her freedom number. So tell my audience, even though most of them know you, some are listening for the first time, your story, why we should be listening to you, and catch us up from where you started till now with your journey.
Well, it is my journey. It's my experience. And it's not just my experience, but I've been blessed because of the freedom I was able to achieve, not in a linear path, but going through many different iterations to help other dentists. So like you, I am one of us. I've been there. I understand the trenches. I understand what's out there. I understand the hurdles that are in place. And I connect with
When did you graduate from dental school? What year was it?
83.
And I want to share this. Could we stop saying this? Like I tell dentists, don't call teeth virgins. Don't say things fail. Don't say, we have to save this tooth. Say the tooth's ready to retire. Say tooth without a filling. Can we stop this, David? I'm going to ask this question. How long were you a wet-fingered dentist? Which I think we should stop saying, right? It's not a very pleasant, but that's what dentists know. So how long were you a wet-fingered dentist?
21 years.
21 years. So 21 years, you're doing fillings, you're doing crowns. And I think, I see a lot of myself in you, and I think of you as a mentor. You don't have to hate dentistry to want to do something else. Like, you don't have to get up every day and say, I hate this. However, something inspired you to shift gears, pivot, and do something else. Tell us the shift from wet finger dentistry, which we should just call clinical dentistry. Everybody stop saying wet finger dentistry. Last time I'm going to say it. What caused you to shift from clinical dentistry into another space?
Yeah, the shift came at about, the shift came at about the 21 year mark, but the little bit of history that preceded that is that when I was in college, this is what makes me a little bit different. Yeah, I guess unique's the word to put into it, but I was not only studying for the DAT and getting through my anatomy and physiology classes, like, I did organic chemistry, but I found the bandwidth, going back to our term, to read a little bit about being an investor. I just always wanted to be an investor. And to me, that word just meant you're good with money. I think that's all I knew. And I didn't know anything more about that other than I just read book. I had went to the library, went to Walden's bookstore because you couldn't get anything on the internet. We didn't have the internet back then. So I had to just get books, and I read books on the stock market, and the mutual funds were just coming out then. And that was interesting. And then I got some books on real estate, and it just made a lot more sense to me. I'll just put it that way, a lot more sense. So I did my career path in dentistry, getting out of school in '83. I'd already bought my first rental property in 1980, and I parlayed that into more properties. And a few years down the road, I had built up a sizable portfolio of rental properties, pretty just standard stuff. Vanilla ice cream. What you think is the first layer of I want to be a real estate investor, so I'll do that. And I did that. And I was able to do that. Let me be clear to people. I was able to do that because my wife and we got married when I was right out of dental school in '83. She had a career path as well, and we just made a decision that we were going to have children for 9 years. I mean, we decided. So I had time. Now, if I would have had kids, this would not have worked. So what I'm telling people is, don't just take what I did in my history and go say, well, I'm going to go out and buy rental properties. By the way, it's not the right time in the market. Now, the shift came because my daughter, Jenna, who she just turned 31. Can you believe it?
Awesome.
31 years
That's
old.
awesome.
I mean, they grow up, Paul, they grow up so fast. But when she was very, very young, she was diagnosed with high-risk leukemia. That was in 1995. So we're going back almost 30 years. So she was very young, and she got through that. The marriage to her mom, great lady, and still a huge advocate, and I'm a fan of 100%. We didn't make it. This is the stress, right? It's no fault, just stress. And I kept kind of hard charging, but it was devastating when a family breaks up. It's just hard. It's hard financially. It's hard emotionally. It's just many ways. But I was still able to dedicate the time I had with my daughter. I kept plugging away, and then a few years later, unfortunately, because of all the chemotherapy she had, she also had seizures. So she had to take a lot of anti-seizure medication, epileptic seizure medication. All that was too toxic on her liver, and she was in end-stage liver failure in 2004 at age 12. And so that was my breaking point. So you asked for the shift. All right, that's the shift. I'm in the hospital with her post transplant, and it was successful. Obviously, she's living today, but it was difficult. And I'm sitting there watching her breathe, just watching her breathe. She's drugs and tubes and everything everywhere, like anyone who's gone through major surgery. And I just really thought, is this the plan I should stay on? And that was the first time I really took to account, not that I had some big massive portfolio, Paul. I wasn't some big multimillionaire, but what I realized then, when I did my back of the napkin accounting of what I had in terms of, I'll call it passive cash flow. It's semi-active because you have to manage some stuff here to make this happen. But I had enough with the sale of my practice. So I'm thinking, if I sold my practice, I know what to do with the money. That's a key thing. I knew what to do with the money because I'd had some experience, some practice, right? I could put that together. I could buy myself some time. It's all I wanted right there in Paul. I wanted to buy myself some time, not retirement, not done forever, but how could I buy myself at least 12 months, maybe 18 months, where I could just focus and be present when my daughter was, whether she was sick in the hospital, recovering, or she was well. And I need to be freed of the practice, because the practice, as we all know, you're an owner. You can't just, well, very few people, I wasn't of the capability to have, I had associates, but I had to be there, right? I mean, it wasn't just associate driven. It wasn't the nirvana practice like people talk about. I had to be there, because if I'm not there, it's probably not going to run really, really well.
And I want to share, David, I appreciate you
Yeah.
sharing this vulnerability.
Yeah.
I want to share some of my own. Some people know my story. And listen, there's a lot of awesome parts about owning a dental practice, and there's just some downright awful and annoying ones. So sadly, my mother passed away suddenly when I was 20, right? And my dad was 52, and he was back at work the next week running the practice. Now, it was for two reasons. He was the type of person who that helped him, right? That did help him routine. But also, if you're not the one back there, the team doesn't make money, the patients aren't seen. And he had a dental partner, right? And then fast forward to when I was 38, sadly, my dad passed away suddenly. My brother and I were back at work a week later, because if we weren't there, the team wouldn't get paid, the patients wouldn't be serviced. So this is not to say don't be a dentist, be a dentist. There's some awesome parts about owning a practice. But what you're talking about is the dentists have to show up, and as Rob Montgomery said, make those dental donuts every day. And it's nearly impossible to take a month off from your dental practice in a way where you could. So I really appreciate you sharing that context, where that was your motivating factor. I really admire that. So you take this 12 to 18 months off, you sell your dental practice, and what do you move into next?
Well, I had, besides the focus on my daughter, which was the key element here, right? But I finally had some space in my life again. And this is a critical thing. It's what I find in Freedom Founders is when people can have some peace of mind about having some space, some margin, some bandwidth in their finances, where it's not like you're in chokehold because you have to be back at the practice, every day, every week, like you said, barely take any time off at all because you feel like, the overhead goes on, and it does. If you can build some margin, and you can build some margin in two ways, with everything you do through Dental Nachos to help people build more efficient, productive, profitable businesses, practices. That's number one. And I would always focus there. Secondarily, multiple streams of income. I'm back to the cash flow model, the, quote, passive cash flow model. It took some work for me to get there. I'm not kidding, but there's ways to do that today where you're more constructive about how you're investing your money than, again, I say just putting it in the stock market, the Wall Street. And because I had the multiple streams of income from the real estate, and I knew where to put additional capital from selling the practice, then I could have that margin. So when I had the margin, I fully expected to go back to dentistry. I thought, I can always go back and be an associate somewhere for a while. I could fire up another practice. It was open to what I want to do, but I didn't go back. What I found was, in that time of having that space, not that dentistry was great, but I was able to do more focusing on the real estate I had been doing more passively on the side, and focus more on it. And we were coming around to where the market was getting closer. We're getting closer to 2008. And then when 2008 hit, it was just assets were on sale everywhere. Dental practice assets were on sale. Real estate was on sale. Stock market cratered. It's this big time where it's the right time, right place. And I was able to just magnify my wealth because I had experience doing what I've been doing. So it's some
You said
experience,
something valuable
education.
just for me to reinforce, and I'm really the bystander to your expertise, but you consistently said, especially when you sold your practice, you knew what to do with the money. So it's kind of, this seems like this theme of anybody watching in, somebody watched in who is watching in, who I was just talking to this afternoon as a new associate. I see my team members watching in. I do want to share, David. I don't want to say this hurts my feelings, but I run Zooms where I teach people how to talk to patients and do better treatment planning. I get 4 people on, and now you have almost 10 times that many here on Zoom. So your topic is a lightning rod for dentists paying attention. So I kind of want to go to that.
Mm-hmm.
Why is that, whenever I do so many pieces of content, so many different TV shows, and why are dentists so tuned in to pay attention to this? Is because we don't learn anything, because dentists retire later. Dentists are making $200,000 to $400,000 a year, but they retire later, as far as I know, than most other professions. What do you see? Where do you see they go wrong in this? I have a couple questions here to just get us. Where did they go wrong with this? Because most dentists don't want to be prepping a tooth when they're 80. But sadly, there's still some dentists prepping at teeth are 80, not on their own terms, right? You want dentistry to be your hobby and you want to do it when you're 76 or 8, but this is not on their own terms. So where do dentists go wrong with retirement that you see?
Well, there's several areas. I think the first one is what I've mentioned already is really just abdicating that responsibility to other people. Not that you shouldn't have other people advise you. I totally think, but I think you've got to learn to be. I say learn to be. You're not going to be without some time, but learn to be your own financial advocate, and then use advice from other people. You need to be the driver. So that's number one. I think number two, there's been, a preponderance of speculation in a lot of markets, and I'm not putting any of these down, okay? But crypto, right? Crypto's a big one. There's the meme stocks. Of just a few years ago, in places of real estate, there's been speculation. You can financial assets. The stock market's being carried right now by 7 tech stocks. I mean, to me, that's all speculation, and the world and people start to think that, well, whatever they've seen in the recent past, well, that's just going to continue, or maybe there's a little dip and then it will go back to what it was, back to normal. And I just have to tell people that I just don't believe that's going to be the case. I mean, the elephant in the room is the debt and deficit spending in this country, and nobody talks about it. Nobody talks about it. Like, it's just like, no, it doesn't matter. It does matter, and it's going to catch up, and it's going to change the dynamics of the markets, the general markets going forward, whether it's dentistry, dental practices, whether it's the financial markets, stocks, bonds, whether it's real estate, you pick it. I believe we're going to go back to a somewhat similar situation that we had. And again, this is probably before most of the listeners that are here, but I was a kid back then, but in the mid 60s to the early 80s, say 65 to 82, that period of time, if you were in the stock market or had a 60-40 typical traditional bonds, stocks bond split, which is kind of a long-term portfolio management for people that are building towards retirement, you were lost money because it was a sideways market. My point is there was like no growth. It was flatlined. I'm not saying we're at exactly that, but I don't think we're going to have this big growth that we've seen and all the speculation that's pushed the market up in these different asset classes. I think that air is going to start coming out, and then people are going to start going, what do I do now? If you're a financial advisor, again, I'm not putting these people down. You know that, Paul. But if you're a financial advisor, if you're having meetings with that person, whoever it is, your CPA, I don't care who it is, if they're not talking about the changing dynamics of the market and bringing some relevant conversations to that and what they see and what they believe, they're missing the mark. If they're just going back to you just dollar cost average, just buy and hold, it's like, I think that's going to just totally ruin people's expectations. And I don't want that to happen because, Paul, we both know, especially today, how hard it is to come out of school with the debt that our colleagues are having to take on, the ridiculous amount of debt. It's doable, but it's hard. It's climbing that mountain.
And also, it's emotional. It's emotional. If somebody wakes up and they have $637,000 in debt,
it is,
and they're going to an associate position where they're earning $179,000 a year, and everybody in America says, "Oh, you're making so much money," but when you look at it against what they've invested in it, it's just totally normal to feel concerned, and that's why I kind of want to tell this happy story. So I always say I don't violate HIPAA, even when it's no HIPAA, right? So this story is someone who came to me to sell her practice. We won't say her name, even though I think she'd be proud for me to say her name.
Yes, you would.
But she was like 50 years old, and she was part of your group. And she came to me and said, "I want to sell my practice." And the first thing I said was, "Man, you're so young." And she said, "I've been part of David Phelps Freedom Founders, and he has helped me find my freedom number. And maybe you're uncomfortable bragging about yourself, but it's my show, David. I don't care." So I went to Freedom Founders, and I saw all these amazing dentists who were so much younger than I had assumed flying to Dallas, right? I just thought I was going to see a bunch of old people there, older than people. And so when you see a 50-year-old who's been a practice owner who has now sold her practice and still continue to work because it's part of a DSO, but is able to, through what they've done with Freedom Founders, tell my audience the concept of your freedom number. I know it's different for everyone, and how you help people get there.
So it's the difference between what I call the traditional accumulation model, which is really what financial advisors in Wall Street talk about. It's like, save, which is good. Put it somewhere, whether it's in taxable accounts or your retirement accounts, but save, build up a nest egg, sell your business, your practice, and then take that nest egg, but you need to accumulate a certain number. Now, they'll never tell you exactly what the number is. I mean, they might throw darts at the wall, but you have to have some number. And then what you're going to do is when you stop your active income, when you left practice, clinical practice, then you're going to take that and we'll help you invest it. We've got to be more conservative now because we can't risk losing money. So we have to put you in some like bonds, which bonds are conservative, but they don't give the returns that you probably need going forward. So there's going to be some depletion of that nest egg over time. And there's models they have. It used to be you could take 4% out per year. I think they've reduced that. Why? Because we have this thing called inflation now, and people think, well, inflation, they're going to cure that problem. No, I don't think so. The debt's the problem. So the problem is accumulation model versus a cash flow model. So the freedom number is based on a cash flow model. Now, where do you get the free cash flow? Free or passive? Well, it's got to be from some asset, some investment. And that's where we build our number. So we tell our docs, let's hit your freedom number. What does it take to sustain your lifestyle? And then we add 20% safe harbor margin, right? So if it's $15,000 a month, because of where you are in your life and you've got most of your debts paid off and hopefully maybe your house is paid off and your kids are through school, 15,000 a month may be just fine, or 18 or 20, whatever it is. We gross it up for taxes, and then we just say we can get on a conservative nominal basis, whether the markets are going up like we've had, sideways like we are right now, or on a correction model, which I think we're in the middle of right now. If we can get 10%, just using conservative numbers, then we can back that in and say, well, how much do we need of a nest egg to create 10% cash flow? Now we've got a target. Now we have a real target we can shoot for that's attainable, sustainable. And it's not just like, well, I just got to keep building up, because the problem is people won't take their foot off the pedal because we feel guilty. If we don't know how much is enough, then we just keep going because we're afraid, right? We want to provide for our families. We don't want to run out of money when we're in our 70s and go, well, that didn't work out so well. So we feel like we just got to build up the coffer. When you know how to generate cash flow from wherever your investments are, then you've got a model that even when we go through recessions and contractions in the market, if it's operationally producing sustainable cash flow, just like a good, well-run dental practice, doesn't matter what the valuation is. If you're going to operate that, you're going to get cash flow from it. If you're a good operator, right? You don't have to worry about selling it until the day you want to sell it. When you sell it, now you got to do something with that capital. And that's what our mutual friend doctor was able to do, because she goes, okay, I feel good about selling. Now I can make a decision. Is the DSO exit the right way to go? Now I can actually have parameters say, yes, this will work. This will work, rather than I don't know, because it's a gamble.
I want to add, David, right? This is kind of go back. I mean, really loving this conversation. I always like watching movies, right? And they think at the end of the movie, some hero comes in. So let's pretend in your movie for your dental practice, the hero is a DSO with a giant check, like the Happy Gilmore golf check. Right. And let's just say that 4 years ago, that check was going to say $2.5 million. Mm-hmm. Why is that going to say less now? Why is that going to, being at the cost of capital, the lack of expansions, DSOs not being open to buying practice? If someone's saying, I'm going to build my practice and the DSO is going to ride in with a giant check, why would you say be cautious of that being your exit strategy?
Well, the actual number, if it's 2.5 million, the number may still be there, but it's not a sale with a DSO. It's a buyout. Two different things. It's not a sale. A sale means you get the check. In this case, if 2.5 million is the number, you get a check for $2.5 million and you could walk away, or if you want to stay on as an associate. But the buyout is the DSO model. It's what's been done in real estate forever, right? Like when I was buying real estate, I'll just give you an idea. When I was buying real estate when I was younger, I didn't go to banks. I had to negotiate terms. This is the key of sale from people who want to sell their homes. They're motivated. They would carry back financing in equity, and I could buy out from other people because I could give them their price. They might say, David, I want, $150,000 for this house. I say, fine, I'll give you a price if I can set the terms. You understand that model, Paul. DSOs are doing the same thing. Now, a few years ago, when the cost of capital interest rates were lower, then it was easier for them to give more of that 2.5 million up front. Okay. Yeah. Now, today, what they're doing, they'll still give you the 2.5 in the figures, but they'll say, we're going to have to give you a little bit less of that up front. The number, it's ratcheting down. And the earn-out or the buyout period is probably going to be longer. Now, they're still going to base it on history. Normally, we have recaps every 24 months. That's what we've seen in the last 4 or 5 years. Yes, got it. That's because the cost of capital, interest rates, have been low for the last 15 years, next to zero in the federal funds rate. When we've taken those all the way up to 5.5, that changes everything. It changes it in real estate too. Same ball game there. All the syndications, all the go models, and we'll get the profit on the back end. Well, that's just getting strung out. And some of those are not going to even make it. I mean, there's DSOs that will not make it.
Right. So, I mean, that's what I think is important to note, that some DSOs don't make it. And, you know, I work with Rob Montgomery all the time, and he says, you better be happy with that number they give you at close.
That's
because,
it.
yes, they may paint a picture of the recap of the recap of the third bite of the apple and all these cliches, the second bite of the apple. And I think that's so key for our audience to recognize. And that's why my next question, you asked me to do a few years ago this video, which I appreciate, who could buy your dental practice for one of your shows? And I said it could be a private practice dentist that's solo. It could be a group practice like my brother and I. It could be a small DSO or a large DSO. So my question is, maybe there's some associate dentists thinking, I'm going to buy a practice, and the day I sell my practice, I'm going to have this giant amount of money that I can retire on. Why should dentists not count on their practice sale as the main factor in their retirement?
Well, I mean, number one, is your practice of the size, and can you get enough capital, you know, to actually make that work? That's number one. And again, what's that number need to be? Well, it's going to be based on how well you can invest that capital. Like I said, you know, I learned how to do it. Our mutual friend doctor learned how to do it. But if you don't know, then that's going to change that dynamic. So, look, I'm not here to be a downer about practice values, but I think we've seen the high point. Let me put that. I think we've seen the high point. I'm not going to say we're going to hit the bottom. I think we've got to be more prudent, and the young docs who have taken advantage in a good way. It's made sense for them to sell out early. They can take that capital and then they can stay in the game, and I get that. That's fine. That's fun. I just don't see that model playing out.
And I think I think it's fair to say it could be an important piece of your retirement, but thinking it's going to be the only piece that does it. What I'd like to do, we're about 2/3 way through. My people that are here on Zoom, if you want to ask a question, put it in the Q&A. And I would love if my audience would just share one thing that David has said that you have found valuable, that has given you an aha moment, that has made you inspired to do something. I would love to do that if you're here live. So next thing I kind of want to get into, David, because we talked about our audience, dental students, new dentists, people about to buy their first practice. You're on Dental Nachos a lot. These are our core people, especially about to buy their own practice. And even this reinforces some of the things you've already said. Someone listening to this right now is going to say, I'm about to buy my first practice. I'm making $200,000 as an associate. This practice is 800. I can grow it to this. What should they be? I talk about being aware, prepared, and responsibly scared, right? I hope I make people aware, prepared, and responsibly scared. You sign up for $650,000 of dental school debt, you better be responsibly scared. You better be responsibly scared. So now, what should these dentists who are enthusiastic and motivated, but got 0 classes in dental school and all of this, what should they be concerned about in their career with their financial treatment planning? Think of their career like a patient. Break a few points down for them, and even if it's reinforcing stuff you've already said already.
Well, with their financial planning as new buyers, I think you've got to maintain as much of a liquid cash position as you can. It's very, very important. You know, you know the old saying, cash is king. Well, cash becomes actually like oxygen when you need it. When we go into tougher economic times, like I think we're headed, where the banks are clamping down on their underwriting, they're not making loans as easily, and even when they do, the cost is higher. That's when you need to make sure you've got some financial bandwidth. So that's why I'm a big fan, particularly young people, not to fall in the trap of, I'm making good money now, or decent money, and now I'm paying taxes. And I talked to my CPA and said, I hate paying these high taxes. And the CPA, wanting to do the right thing and appease the client, says what? Well, we have some great tax deferred vehicles, and yes, they do. I'm not saying they're great, but they will defer tax, not save it, they'll defer it. And so what happens is they work hard, and then to quote, save taxes, we'll put it in the lockbox, which is what I call the retirement account, the 401k. That's a lockbox, because once it's in there, you can't get it back out again until you're 59 and a half, unless you want to pay exorbitant penalties and tax. So you kind of locked it up. You need liquidity. You need liquidity when you're young, you're starting out, because things change. Plus, right. I also believe that, again, like I said earlier, you should be the best advocate of your capital. If you've got more free capital to use, rather than trying to invest it in speculation or stuff you don't know anything about, why not invest it back into your business? Whether that's you're hiring or keeping on board good advisors. I mean,
Right.
Paul, we both know mentors, advisors, good coaching. I mean, that pays over and over again dividends in just not making mistakes and doing things right. So I think just keeping that capital on hand, liquidity, as much as you can early on is important. You can always make those investments later. Don't feel like you have to jump in and start making all these crazy investments, because people tell you, well, if you're not making XYZ% on this and that, you're just not doing it right. And the social media is terrible about that. It gets people thinking, well, there's something wrong with me, why I'm not getting those big home runs. And so then they start speculating, and it can turn things upside down. So liquidity is a big one. Watch your debt overall. Personal debt, consumption debt. It's very dangerous. It's a tough place to be, and we could even talk. Well, we're not going to talk about it tonight because it's not relevant that much. But do I need to go out and buy the house now, right? Versus rent. Well, you should always own. People, you should always own. Not always should you own. There's again a right time to own, right time to rent. Don't upgrade your life.
I also want to share to you, because it's important. And I talk about that as someone who's a dental practice broker. Buying a home restricts your geographic flexibility, because it's super annoying to sell a home and move somewhere. So it doesn't mean not to buy a home, but if you are someone listening and you really think you want to buy the best practice you can buy for you, renting does give you some flexibility. Because I talk to dentists all the time and they say it's no problem for me to move an hour and a half away. So it's not a judgment, it's just an observation. But just that's why having a good team of advisors and letting people question. I asked before, question some of these social media themes of if you got to buy a home immediately, you got to put your money in this. And like you said, liquidity and I know this, that makes you a good risk for the bank. So when you go for a practice loan of $1.5 million, despite the fact that some banks are fairly aggressive, David, most banks want you to have enough liquid assets to survive a problem. And many times that's 10% of the practice purchase. So you're kind of outlining, make sure you maintain liquidity, make sure your lifestyle does not exceed your income, because you're keeping up with the social media. That's what they call them now, social media. I don't know who the Joneses were of the past, but everyone was trying to keep up with them. So now it's keeping up with the social media Joneses. And I think, it's not easy to be a new dentist, and getting all this bombarded with all this information and things that affect your outlook, where you don't think you're going fast enough. How long, many years did you own a practice for, David?
Yeah, 21.
And I just want to kind of point this out, because you do things with real estate, you do things with your dental practice. Would you call running a dental practice one of the most active ways you could make income, right? It is an intense way to make income.
Sure. Well, that's where it all starts. Whether we're a dentist or doing anything else with our intellect or our hands, that's where it starts. Unless you're a trust fund baby, we got to get out there and do something. Active income is where it all starts. So
and I was leading to say that because I wanted to interject this. I sat next to someone at a C event, and he turned to me this Saturday. It was great. And he said, "Paul, remember me?" And I said, "Oh yeah, I did buyer coaching with you." He bought a $1.2 million practice, and he's grown it to $2 million. He's put in systems, he places implants. And I said, "Oh man, you should be so proud of yourself. And I'm so glad to be a small part of your journey." I go, "What did I say back in 2019 that was helpful?" He goes, "The best thing you said was don't buy too small of a practice." He goes, "Because I wanted to buy a $500,000 practice. And you told me, if you're going to do this practice thing, you may as well buy the $1.2 million one." And that's why I was kind of joking that there's a lot of effort and energy that goes into running a dental practice. Make sure you're set up to buy the best one you can for yourself.
Yeah, sure there is. And the whole key that I try to help younger docs look at is you got to have that active income and put it back, invest first in yourself and in that business, to the extent that you have the business optimized to the point where, okay, there's really nothing else I can put into it, or I've got coaching and stuff. I'm not going to add capacity. I'm not going to build it out. I'm not going to do a second practice. Whenever you feel like you're tapped out there, always invest in yourself, in technical skills, in personal growth. That's always going to be something that you can take to the bank with ROI. And then at that point, start to invest in other assets, the plan B, multiple streams of income, so that you're building that wealth outside. But always start with the practice in yourself. And I think sometimes people get mixed up and they think, okay, I'm a practice owner now, and this seems like it's hard work, and I don't really want to do that long. So there's got to be some easy button I can hit. And if you look around again on social media, somebody will tell you what they just did in the last couple of years was something that blew up, and they're thinking, yep, I should go do that too. Big mistake. I think it pays dividends to stay focused and keep some guardrails on. You can always take what I call some moonshots. Moonshots to me, like that would be like crypto. All right. I'm not dismissing something like that, but that should be an outlier, and you should always have your moat or your main base capital invested in things that you believe in, that you have some level of control over, that you can drive. That's what I think is important. And your practice is certainly like number one on that list.
I want to add that we have a few comments here, and this one is from someone who's extremely smart and not easy to impress. She's going to know who it is when I read her comment. She said, David, I really appreciate the explanation of how important it is to factor in the cost of your lifestyle into your freedom number. I think that's important to reinforce. You said that to my awesome team member before we were on this Zoom. You've repeated it a number of times. So people listening in this moment and also on demand later, how important your lifestyle is when it comes to your freedom number. And also appreciate the commentary on the deficit, the effect the deficit's going to have on the market. So share that one more time for people who aren't as tuned into the stock market as you or this awesome person listening in. The deficit on the stock market, share with us that impact again.
Well, it's going to affect everything. And so, the U.S. has been like, the major financial capital country in the world for centuries, right? We've built up and we've been very good. But we've been as a country and as leaders irresponsible a lot in the last, well, let's just say at least going back to early 2000s. We've always carried some debt, but from 2008 through the great financial crisis to today, we were back at $10 trillion of debt. We're at, I think it's 33.5 trillion and counting, and that number is exploding. No country can get away with taking on massive debt and having a printing press like we've done. We get away with that to a point, but at some point that's gonna fall over. And when that does, that's when the stock market, and when I talk about the market, I'm talking about the people who invest in it. The market's the market, but it's emotionally driven. And when people lose confidence, and they will in this country, I'm talking about foreigners and people in this country, when you lose confidence in the dollar, in the basis of, in this case, this country, that's when the markets will start to implode's probably a bad word, but there's going to be some massive correction. Only thing that's keeping things up right now is the general people right now are still betting that the Federal Reserve will come to the rescue and lower interest rates and pump back up and print that money again, like they've done in the last 15 years. The problem is they're between a rock and a hard place. I'm not here to sell books, but I wrote this book on inflation 2 years ago before inflation really hit. And I'm proud of that book because I could see it coming. And what I wrote in that book is true to this today. The Fed is trying to fight inflation because they thought it was going to be transitory, but it's not. And there's so much baked in to the economy right now. I don't have time to go into it, but they can't just snuff it out. It's not going to snuff out. They'll keep playing with it, and then they try to get it down, but then the economy starts to implode. So then they have to ramp it back up again and print money again. Well, what does that do? That fuels inflation again. So see, they're trying to do this right now. They didn't have to do that when the debt bomb is so high today. The debt to GDP is at 120%. We could deal with it when it was 30%. It's 120% today. That is not sustainable by any means. But our officials, government, Treasury, Fed, they act like, oh, we got this. We'll manage it through, and it's going to crack. I've got articles. I got an article from yesterday from I'm just reading it. Jamie Dimon, chief and Fed of Chase Bank. He said he rips the central banks for being 100% dead wrong on economic forecasts. This is Jamie Dimon, pretty well respected in the banking industry, and he's saying these people are foolish. He's calling it. There's other people that are calling it. I got an article that was Wall Street Journal today, Paul. It says, "Your set it and forget it," in quotes, 401k made you rich, no more. Wow. I've been saying this for 2 years. I mean, people are starting to wake up, and once the dominoes start to fall, it's emotional, and the confidence. It's a confidence game. It's a con game, and when the confidence starts to dissipate, that's when things start to drop. So liquidity, watch your debt. be focused on your business. Your best thing you can have going into an economy like we have right now is have a good, solid business that you can turn the knobs on. As much as that active income is difficult to do, at least you can do it. At
Yeah,
least
right.
you
And,
can do it.
and that should be inspiring to dentists who are doing this. We're going to spend about 5 more minutes here, but I want to ask, where can people buy your books? You can totally sell your books. That's what the whole thing's for. You can share your books. That's selling help. I'm a big fan of selling help. So I know my team member will put it in the Facebook comments and the Zoom comments of where people can find you. But if someone wanted to buy that book, Inflation, or one of your other books, where could they get it?
They're all on Amazon. Just type my name in, and I've got a number of books. But that's probably one that's most applicable to our conversation tonight about the markets and how to look at inflation and the cycles.
And I think this question I want to answer before we wrap up, which I think will drive everything home. Someone had asked about alternative investments. That's not the question. We talked about crypto. We talked about real estate. Please, we're going to give some links to follow David. I've been on his podcast, but I think this question is so good because this is real life. Actually, sorry, David. Before I get to our final question, someone asked who it seems like he's in the know. Does the government have any other choice than to pursue MMT because of the hole they have dug? I don't know what MMT is.
Modern monetary theory. Yeah, they don't. The only viable way for a country to deal with the debt, which is huge, is to monetize it, which means hyperinflation. That's the only viable way, because the only other ways to do it is to tax the heck out of the workers, us. You can't tax enough to pay the debt. Or the other way is to go into massive austerity and reduce federal spending by about 35%. Going into election year, you think that's going to happen? Neither one of those are going to happen. So the only way to do it, really, long term, is to inflate. And that means, in my opinion, you've got to be invested in hard assets, tangible assets, not, I think, financial assets. I think that the long term is over for them. This playing the game of index investing, and it's all been good and ride the market. I think you've got to be involved in hard assets. Again, that would be your practice. Number one, practice, a good business, a good practice, and then other tangible assets, whatever you like. Could be other businesses, multiple dental practices if you're good with that. I just happen to like real estate. But I think tangible assets, because that's what's going to keep up with inflation. Right.
I appreciate that. The question I think that will really bring this home before we share a field is that he said, thanks for answering, Dr. Phil. Real quick, because does Freedom Founders make sense if you are not an accredited investor yet?
No, and it not even to do with being an accredited investor, which has a definition of so much net worth. It's more based on where you are in your practice, what your debt levels are, and how operationally efficient you are. We kindly and nicely turn people away, not because we don't want to help them, but because you've got to be a certain place. I want people to focus, and I set people up with other people to help them with their practice models. Get up to here, get some debt paid off, and then we can talk. So I'm very, very careful about that.
And we're sharing that you're super responsible with those things. I've been at your events, but we'll share how people can listen to your podcast. Lindsay put in the chat. But this is a question I want us to answer them. How early, this is a real person, should one start working with a financial planner? I'm graduating dental school. I'm consider having one. Before you answer, David, these are my people. You graduate from dental school and you might hear saying, these financial planners aren't so great, but then doing it yourself might not also be so great. So where is this middle ground? My grandma would say willy-nilly. You don't want to willy-nilly sign up with a financial planner because they have a glossy one sheet, but you might not also want to try to figure this out on your own because you don't have the knowledge. So answer this question for finish up. How early should someone start connecting with a financial planner? And if they do, how can they do so responsibly?
So I think you can start early, but I think you want to be careful about what you allow them to take charge of, if I could put it that way. Certainly, there's lots of things that financial advisors can do, I think, well, and it has nothing to do with investing in the stock market or index funds or annuities and all the other products they have. I think, a good advisor can also help people or young couples or with families with their insurance needs. I'm not going to go down the rabbit hole there, but insurance needs, maybe some basic estate planning, other types of insurance. I think there's things that they can do to help there. I would say,
I just want to say, getting disability insurance. There's a dentist right now who can't pay her rent because she didn't connect with the Jim Cashmere, Tyler DeStefano, and you need some basic protection So just ask the right questions. My team can put the disability insurance. If you are a dentist, you need disability insurance ASAP. There's some scary stories, and that your income can go from $15,000 a month to zero, never to go up again without it. But I didn't want to cut you off. I just wanted to add to that. So you were saying that
No,
basic
no, no.
insurance is
Yeah, get some help with the basics. I would say do some reading. And look, as I said earlier, when you're younger, you don't need, please, at least for a while, until you read and get some of your own convictions. Don't play the game of dumping it, into 401ks. Please. You can do that later if you want to. But read, get some foundation. I'd even be careful about the stock market in general. And because I'm the same thing about real estate right now. Equities and real estate, I'm not a fan of right now. We're playing the other side, the debt side. So my point is, you've got time right now. Save, even if it's just saving money. You go, well, gee, David, if I save money, am I not losing purchasing power because of inflation? You can get 5.5% interest in treasuries today, or a lot of money markets today. That's right now for, let's say, for the next 12, 18 months. That's good enough, because again, you're not going to hit any home runs. You're not missing any home runs by being a little more patient right now. Now, 2 years ago, I might have told you something different. So I'm being very, very careful about looking at the marketplace. But right now, you are okay to just be prudent, save money, be disciplined. Don't let your lifestyle get out of hand. Focus on your business, your practice, your skill sets, investing in yourself. Put your money there right now. Financial advisor, just get somebody to help you with the basics. Listen to them, but read books and be interested in alternatives. Just be interested. That's all I'm saying. Okay.
Awesome. I absolutely love it, David. Thanks so much for sharing with us. Stick around for a minute before we go. If someone wants to reach out to you, to connect with you personally, listen to your podcast, where's the best place for them to do that?
Best connection would be the website, freedomfounders.com. I do a weekly podcast, which people would probably find interesting because it's mostly about financial, but we talk about practice models to some extent, not as well as you do, but we do talk about that because it's interesting. That's the Dentist Freedom Blueprint podcast. And then I put out a lot of video blogs just on YouTube. I think it's just Dr. Phelps. Probably find me there on YouTube if you want to pick up some stuff there. So that would be the best places.
Awesome. You are just incredibly generous, David. Stick around for a minute, but thanks so much for sharing on this
My pleasure.
episode of Talking Nachos.